All right, let's look at the data. Right now, there's a critical divergence happening in the market. You've got widespread fear on one side, and on the other, you have these highly concentrated, aggressive bets from institutions. This tension, it creates what I call a coiled spring scenario, and today, we are going to break down the mechanics behind it. And here it is, the core conflict. On the left, you see market sentiment just cratering. Tons of stocks are hitting 52-week lows. That's capitulation, plain and simple. But look to the right. While everyone else is selling, institutions and hedge funds are building extreme short positions on these very same names. When you see conviction this strong on both sides, it's not just noise. It's a structural anomaly, and it's screaming that major volatility is just around the corner. So this is the million-dollar question, isn't it? When you've got this kind of extreme divergence, Main Street is throwing in the towel while Wall Street is doubling down on their bets, what is the real signal? Let's dig into what the data is actually telling us about the move that's coming. Okay, so let's break this down. To really understand the opportunity here, we have to start with the core mechanic that's driving this whole situation, short interest. So what exactly is short interest? It's pretty straightforward. It's the total number of shares that have been sold short but haven't been bought back yet. Think of it as a direct measurement of how much money is betting against a stock. When that number gets really high as a percentage of the available shares, it's a huge tell. It means a big, often institutional chunk of the market is convinced the price is headed down. And this is not some theoretical concept. Just look at the current data from MarketWatch. You've got companies like Eurogen Pharma and Symbotic with short interests climbing towards 30% of their entire float. That is an incredibly crowded trade. It signals huge institutional conviction, yeah, but it also creates a very, very precarious situation for the short sellers. And that precarious situation is exactly what we call the coiled spring. This is the inflection point where all that bearish pressure, all that high short interest flips and becomes potential rocket fuel for an explosive move to the upside. This is the anatomy of a short squeeze. You know, understanding the mechanics here is absolutely critical. It's a clear chain of events. First, you get the massive buildup of short interest. Then, some kind of catalyst hits. Could be good earnings, a patent approval, anything positive. That sparks the initial wave of buying. As the price starts to climb, those short sellers are forced to buy back shares to close out their losing positions. And that forced buying, that's the ignition. It creates a feedback loop that can launch a stock with unbelievable speed. This quote just nails the dynamic perfectly. All that high short interest is just stored potential energy. The more crowded the short trade gets, the more tightly that spring is coiled. The only thing missing is a spark to set it all off. But let's be objective for a second. Not every single stock with high short interest is going to be a squeeze candidate. We have to be smart and analyze why the institutional money is making these bets in the first place. Are they seeing a real risk that we're missing? Or have they just gotten way too far over their skis, creating an opportunity? Just look at this number, 29.22%. Let that sink in. This isn't just a small hedge. This is nearly a third of the entire available float of a company being actively bet against. We're talking about massive institutional conviction, billions of dollars on the line, all based on the idea that Eurogen Pharma is going lower. That's a heavy weight on one side of the scale. And it's important to understand this isn't necessarily about them being villains. Institutions take these big positions for strategic reasons. Maybe they have a really strong thesis that a company is overvalued, or maybe they're just hedging a long position in the same sector. Or they could be front-running what they expect to be a negative event. This is just how the market works, and their positioning is valuable data that we can use. Okay, so given the big institutional bet on the other side, how do we spot the turning point? What's the signal that the tide is shifting and that coiled spring is about to snap? Well, for that, we turn to the charts and the price action itself. You know, the earliest signal of a potential reversal almost always shows up directly in the price action. There are specific candlestick patterns that can tell us that the balance of power between buyers and sellers is shifting, often way before the headlines catch on. A key pattern to watch for is the hammer. When you see this during a downtrend, that long lower wick tells a very clear story. Sellers tried to push the price way down, but buyers stepped in, absorbed all that selling pressure, and drove the price right back up. It's a classic sign of seller exhaustion. An even stronger signal, though, is the bullish engulfing pattern. This is where you have a strong green day that completely engulfs the entire body of the previous red day. This isn't just a pause in the selling. It's a potential signal of a decisive shift in momentum, where the buyers have just taken complete control from the sellers. And as this analysis from Research 360 points out, seeing this pattern in the middle of a bearish trend is a high probability signal that the entire trend might be reversing. This is exactly the kind of trigger that can start to make short sellers get very, very nervous. So let's put it all together. For any of these stocks that are heavily shorted and hitting 52-week lows, you've really got two clear and opposing outcomes, and you have to be ready for both. The bull case is the coiled spring we've been talking about. A catalyst hits, the charts confirm a reversal, and the squeeze ignites. That's the high volatility opportunity. But the bear case is that the institutions are right. The company's fundamentals are actually weak. No good news shows up, and the stock just keeps grinding lower. The key is to stay data-dependent, not emotional about it. And of course, I have to say it, this analysis is for educational purposes only. The data we've talked about is just a snapshot in time. It changes fast. You have to perform your own due diligence. We're tracking these flows in real time. So while you're analyzing the next move, check out the tools we use in the description. You can sign up for Public and get $20 in free assets, check out Webull for that BTC promo, or look into NVDA on Moomoo. All the links for that are right down below. And hey, like and subscribe for more deep dive analysis like this. That's all for this one. Stay disciplined, stay liquid.